in what aspect of the market now is a safe area? Because we're seeing volatility in all of the asset markets and even gold, which in my opinion should be rocking right now, is really lagging.
Mhm.
So what's a safe area for an investor to look at? Is it just cash? Do we just wait in cash and hope it works out? Or what are you recommending to the people you talk to?
Yeah, so that answer depends on what you do for a living. If you're a professional investor and someone who can't sort of let's call it take their ball and go home by raising a significant amount of cash, taking down your gross and net exposure, or taking down your gross and net exposure, then you're someone who is sort of relegated to playing the sector and style factor battle within the equity and credit markets. Within the equity markets, it's pretty clear that you want to be in defensive, lower beta type names. Low beta as a style factor, dividend yields as a style factor, healthcare, consumer staples, sort of triple net REITs, those types of sectors and industry exposures. And obviously on the short side, it's pretty clear anything high beta, anything growth, anything sort of kind of cyclical, with the exception of energy. We would caveat energy's on its own little cycle here, but so it's pretty clear from a dispersion perspective what to do in the equity and credit markets. It's also pretty clear that within the fixed income markets, that you're having a lot of I would say it's less clear to do what to do from a dispersion perspective in fixed income markets outside of just being super short duration across the board across all products. We would actually make the case that spread products are to be sold as well, sold on strength as well, because we're certainly heading into we believe that we're heading into a deeper, faster deceleration in economic activity. That should weigh on corporate margins and cash flow expectations, et cetera. If, however, you're not a professional investor, so those are the kinds of conversation I'm having with our, what we call our pro subscribers. These are hedge fund, mutual fund, RA type investors who need guidance on, hey, I got this egg and it's not going anywhere. So how do I reinvest it, reallocate it? And then there's our sort of retail type subscribers. We have a lot of folks who kind of are native to the crypto space, who subscribe to our macro research. And I tell them the same thing, which is a very different question, a very different answer than I just gave you, which is, if you have the ability to raise cash, go raise cash. Go allow yourself to sleep at night. This is the so I'll quote a stat. When we turned bullish in the fall of 2020, bombastically bullish at that point. I don't think I've ever been as bullish prior to 20. I think 2017 was like the only time I'd been more bullish in my career personally, which was, we're saying, hey, look, there are 5 things that are about to happen, at least according to our models at the time. This is October 2020, that are about to happen that almost never happen at the same time. Growth is going to be accelerating. Inflation is going to be accelerating. Corporate profit growth is going to be accelerating. Margins will be expansion, all that good stuff in that bucket. But then you also going to have aggressive monetary easing and aggressive fiscal easing. There've been like 10 quarters, not like there've been 10 quarters prior to that moment since 1960 that where all those things have happened at the same time. And obviously, you imagine, the annualized returns on things like the S&P are extremely high. And I'm like, hey, we're about to get like 3 of these quarters back to back to back to back, Q4 of 2020 and obviously first half of 2021. And so it's no surprise in my perspective, from our perspective, that we saw such aggressive price appreciation in pretty much every financial asset. If you couldn't tie it down with the ribbon, then it was floating away from a price perspective. Well, fast forward to today, we're effectively on the precipice of seeing the exact same dynamic, but in reverse. Growth will be decelerating. Inflation's likely peaking. So by the time we get into the third quarter this year, we'll have inflation decelerating. We'll have corporate profit growth and margins compressing. We'll have aggressive monetary tightening, aggressive fiscal tightening. It's literally the exact opposite scenario that created bubble price charts for every risk asset, known to man. And so the expectation that we're going to somehow survive the opposite of creating bubble price charts for every risk asset known to man is one that's it's a fallacy, in my opinion. And so understanding that it's a fallacy, the most natural conclusion would be to say, hey, look, if you don't want to lose your stress over trying to sort of trade every single wiggle in the market, because most wiggles are going to be, angled down, unless you have the ability to generate returns consistently on the short side, you probably do well just to book your gains and give yourself some time and breathing room, opportunity to wait and go buy assets that you like back at a lower price. It's not, a lot of money, a lot of capital has been lost by short sellers in bear markets. That's when you get the largest sort of deviations to the upside typically, in terms of squeeze risk. So it's hard managing bear markets.